Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending January 20th, 2023. I'm Preston Brent. Thanks for tuning in. This week's theme is, will our momentum last through the end of January? I believe it probably will through at least February 1st, once we get the new Fed policy statement and interest rate decision. Let's take a look at where we've been this past week. Mostly slightly flat, slightly out of the money. You can see weeklies for the week. Dow, S&P, Russell down a little bit, NASDAQ up just a little bit. Everybody is year to date in the green. Dow came down the most. You can see in the upper right hand corner of the forward PE ratio 17.54. I still think that's got more downside to it. Dividend yield in the S&P 1.72%, 10-year Treasury 3.51%. You can see the earnings yield is 5.7%, and then the S&P earnings yield over the 10-year Treasury 2.2, but the real yield is still negative. And then the current VIX, it was up a little over 10% for the week. Not surprising. The prior week, the VIX was at 18, just about, and now it's moving back up. Every time since January of 2022, we've seen the VIX get below 20. Doesn't stay down there more than a week, and then it starts usually moving back up into the 20s. We'll see if it can hold here through the end of January, although with the upcoming Fed interest rate announcement as well as earnings, we'll see where this thing shapes itself out. Best performing sectors for the week: communication services, worst industrials. Year to date, so far in January, communication services leading the way with Staples bringing up the rear. One other thing that I'm passing under our members is precious metals, and gold is having a good time. I mean, they're doing fairly good. In fact, since October, since we've seen the lows this past October in the S&P before we had the rally into the end of the year, gold is actually outperforming the S&P. Gold is up 14.6%, S&P up a little over 11.8. And gold has been up 10 out of the past 12 weeks. So this is the first time in 50 years, guys, that gold has led the S&P when coming off a market low. So unusual, a lot of reasons for it. Members, we'll go into a little bit more detail on gold for our Sunday evening weekly Market Watch overview. But as I said, we like gold this year. I like gold this year. So it's a little bit about what I think there. We did get this week a lot of signals that the economy is slowing down significantly, right? Following the aggressive rate hikes that we've seen thus far. I mean, this Wednesday, we got a 1.1% drop in retail sales. We got a Labor Department reported PPI, producer price index. It fell 50 basis points in December. That's the biggest drop since early in the pandemic. We did see industrial production fall by 70 basis points in December. That was the most since September 2021. So all these rate hikes are really having doing what they're supposed to do, which is slow the economy down. Okay. And for the fourth quarter, we got the industrial sector of the U.S. contracting at an annual rate of 1.7%. So we're getting all of these signs showing that the economy is slowing. The job market is still very tight. All right, we've got weekly jobless claims falling to the lowest level since April of 2022. And we are getting housing starts, existing home sales falling a little bit as well. So we're getting some of the signs of a slowing economy. Meanwhile, Treasuries posted a solid return, and so far in 2023, the bond market is just on fire. We're seeing the Fed Fund futures, by the way, is putting a rate hike February 1st, 25 basis points, over 98% probability of a rate hike of just 25 basis points. Okay. In addition, the markets anticipate another 25 basis point rate hike in March before the Feds are going to be forced to take the current rate at that time of 4 3/4 to 5% down, actually do a rate cut in November, December of this time frame. Meanwhile, in contrast, the Feds and all the Fed governors this past week keep saying, oh no, au contraire, we're going to run the rates up over 5% and we're going to hold them longer than the markets think. So we've got this bifurcation going on with what the Feds want to do and what the bond market is saying they see happening. So it's going to be really interesting to see how this thing shapes up. Okay. Meanwhile, if we come over and we look at Europe, you can see everybody was in the red in Europe. Everybody, Euro stocks, FTSE, CAC 40, DAX, all major indexes across Europe in the red. Year to date, they're doing much better than the U.S., which is why we like the euro. I like the euro over the U.S. dollar. I think there's a lot of money going into Europe, more so than the U.S. In fact, most U.S. portfolio managers are underweight U.S. stocks, the most underweight U.S. stocks since 2005. So that does mean if we do get a big rally, you could see a lot of money come in and take some of the shorts out again in a little bit more of a short squeeze. But that's kind of what I'm seeing. But looking over in Europe, the ECB president, Christine Queen B. Lagarde, she kind of dismissed market speculation that a fall in energy prices is going to allow the policymakers a little bit more room to slow the pace of their monetary policy tightening. But she basically came out and said, I would invite the financial markets to revise their position. Pretty much what the Fed governors are saying here as well. So we'll see who's going to win this battle. The central banks being a little bit more aggressive in their rate hikes or keeping rates higher for longer than what the financial markets are saying. Okay, we are seeing across UK and Europe inflation is coming down, although UK inflation is still double digit, coming in at 10.5%. But outside of that, we're going to see who wins this battle. And then, of course, looking over in the Asian markets, Nikkei, China, Hang Seng, all in the green. All in the green year to date as well. Hang Seng is having a great start. But again, in that January effect of being a dog in 2022, those dogs that really underperformed in 2022 are really catching wind in January this year. So the key is not so much that, but where are they going to go after we get through February and March? So be very careful of these short-term pops that we're seeing across these asset classes that did so poorly in 2022. Okay. In Japan, we're seeing sentiment is being supported by the prospect of China's reopening. It's boosting global economy, adding a little bit of lift also to the commodity market. And investors are basically, regarding the Bank of Japan, just focusing on where they're going to take their rates. We did see the core CPI in Japan rise to 4% year over year. That's a 41-year high. I mean, Japan has been trying for several decades to get their inflation up, and now they're getting there. But they're still in a very easing condition, with the Bank of Japan still participating in the financial markets, putting a lot of liquidity in there. So we'll see how that shapes itself out. We also got their Prime Minister, Kishida, basically saying they're going to take the legal status of COVID. They're going to downgrade it this spring to kind of the same level as seasonal influenza. So most countries are now opening back up, as China, as the U.S. has done in Europe, and just letting COVID run its course. Meanwhile, China, they've had 4 consecutive weeks of week-long holidays coming up. We got the New Year's celebration in China, so everybody goes on a 1-week holiday. Markets are closed most of the week for China. GDP in China rose 2.9%, and was for the full year at 3%, which is very, very low. That growth pace is the lowest they've had since 1976. Okay. Now, for this new year, 2023, economists predict China's economy is going to grow closer to 5%. And a lot of the same analysts predict that the PBOC is going to continue to put money into the economy like Japan. All right. Just remember, just because they opened up their economy, as I'm telling our members, just because they opened up their economy does not mean that the citizens are going to get out and start spending a lot of money right away. They're just not going to do it. Generally, when a country's been closed for as long as they have, and they've been doing draconian effects, when they open up, citizens don't want to go out and start spending right away. They're going to sit and hold money in their pockets longer. They're just still very scared and nervous. So that's why I think the People's Bank of Japan is going to come out and help stimulate the economy. So that'll be a net positive for the economy, because as you guys know, Most markets love free money. Now, if we come over, let me just switch over and just take a look at some of the key market indexes as we're getting through halfway through the month of January, coming into the end of January. It'll take a few seconds to come up on the screen, but what you're going to see is the E-mini S&P 500 futures, and it's a daily chart. You can see I have marked on the screen the intraday high, intraday low, the opening or the closing price of 2022 and where we are right now. Okay. So as I've told our members, we're sandwiched between this R1 zone, which is a resistance zone, and this S1 zone. I don't know if we're going to have enough energy to take out the 4035 high before we get to the end of the week into the following Wednesday when we get the FOMC policy statement. But we will see how this shapes itself up. Okay. If I switch over and just give you another view, a little bit of a longer term view, you can see here every rally, and these are substantial rallies. This goes back to the highs made, all-time highs made. This is the SPX cash index, all-time highs made on January 3rd, 2022. We've had substantial rallies. 516 point rally, 689 point rally, 592 point rally. Every time we've come up to this trend line, we can't hold it for the week. Now you can see we hit it again last week, and then we came down hard. Now that candle looks like a hammer, which would suggest markets want to break out of this downsloping trend line and move higher. We've also got an upsloping trend line that's playing an active role as well. So we're stuck at the crossroads, which makes sense to me coming into some major events. This next week we get, I think, a couple of hundred companies are going to be announcing their earnings. The big guys, the conglomerates, and everybody outside of the financial institutions. We're going to start to see some oil industry companies announcing towards the end of the week. And this is going to give us a good clue as far as the forward guidance. Earnings so far are coming in below X, or coming in on a percentage statistical basis, downgraded from where we've seen in the past 5 and 10 years. So the earnings are not that good. You have sparks of beats, but a lot of them statistically are not coming in as well as they should. So, but this week is going to be a big tell, and we're going to see where earnings want to go. But we're at a key crossroad here on this downsloping trend line. Like I said, going all the way back to January 3rd, 2022. Okay. Now, if we come back here, and if I just take it down, and let's just get that off the screen here real quick, and let's come down to volatility. You can see the VIX. Every time we come down low into my yellow zone here, you can see we move back up. And this goes all the way back to the beginning of 2022, right? And now we're sitting right on that zone there that divides a light red to a yellow zone, kind of a cautionary zone here. And I think we're going to stay bid and volatility over the 18 level at a minimum until we get through the FOMC. Now, it's going to be a battle of wills. The FOMC is saying they're going to be aggressive in their rate hike, but they're reducing the rate of change, meaning they'll go down to 25 basis points. But as I said earlier, they're going to keep the rates up higher for longer. Most of the Fed governors are saying over 5%. The markets seem to indicate no, they're going to peak out around 4.75, 4.8%, and then start coming lower. So, one of them is going to win, one is going to lose. The Feds can put the markets in a harder recession. And if they do that, then we got another 10% downside action. Right now at this time, as I've told my members, I suspect in the late February, March, April timeframe, we'll make new lows, take out the October lows, and then we'll start to bottom, consolidate, and then move up towards the second half of the year. If we look at treasuries, well, treasury market, you can see here, I have a near-term target of around 136 and 13 ticks, moving up a little bit higher, which means interest rates can go a little bit lower, okay? That's kind of where I'm seeing this right now in the bond market. And if we look at the interest rate, if we look at the 10-year rates, you can see here with the 10-year rates, we're backing off. I do believe the 10-year rates are going to come down lower as the bond market moves up, testing the 200 EMA here around 3.2 for the 10-year. Keep in mind, as as the bond market goes up and interest rates go lower, that is not a vote of confidence in the market growth potential the remainder of 2023. Okay. I haven't seen any analyst yet say we're going to take out the all-time highs we made this past January 2022 of a little over 4,800. Haven't seen any analysts saying that. Most of the run I see by most analysts are anywhere from 4,300 to 4,600 at the end of the year. Now, how we get there, according to these analysts, is going to be very choppy. I do believe the first half of the year we're going to experience new lows in the market. Okay. If we come over and look at currencies, well, our members are making a lot of money on our call with the dollar. You could see I think I even included this in this free weekly roundup. Right over in this area here, I said short the dollar. And the best way to do that, the best way to play a down dollar is go long the euro. And you could see it's just been moving down. And you can see on the euro, I think I even shared with you guys in our free weekly update, the call was made right over here back in early November. And the euro at the time was 101.28 to the dollar, and now it's at 108.9. That's a great run. A lot of money being made. You can see the 50 cross over the 200 to the upside, so we're now back in a bullish environment again on the chart. I do see a possible pullback here, but use that as a buy the dip moment. If we do get a pullback below the October lows, I move down to the 3,400, 3,400 area, then expect the euro to pull back, the dollar to get stronger. So we're going to want to buy the dip in the euro. All right, just understand that. And now if we look at gold, this is one of the ones I told our members this year, gold, you want to be long gold. You can see here, I haven't even adjusted it yet, but you can see gold's making new highs. We've had 10 out of 12 weeks in a row, gold moving up. You can see we've transitioned to a bull chart with the 50 over the 200. Any dip, you want to be a buyer in it. You can see where gold finished last year at 1830 to 1925. So I'm going to update all of my charts on this. But you want to be long gold or gold miners. Copper is a real interesting play here. A big part of copper in this big move here is when China mentioned they were going to be opening up. You can see this line right here is the demarcation between 2022 and 2023. It's like money just poured in. It was finding support at the 50 EMA, but when China said they're going to open up their country and get away from their zero COVID policy, away it went. Okay. I, in fact, had called copper to come way down here, but when China did that, we'll look at changing the pattern here. What's also helping copper move up with China opening up, the theory being China's going to be getting more into the real estate side to support their economy, buying in industrial metals and things like that. Copper's a big buyer of it. There's some shortages of copper with industrial mines. I think globally, 10% of all vehicles sold were EVs, and EVs uses 40% more copper per auto than a gas-powered vehicle. So there's going to be still demand for copper. I think it's going to go higher. But if we do get that ugly pullback, a scare the children moment, into February, March, April timeframe, copper's going to come back down, but use any dip in copper to go back long copper. And there are a couple of different ways to play it. Members, I'll go through that in our Sunday evening session. And of course, with energy, I think energy is going to vacillate around here. You can see where it's down here, but I'm basically going to be long energy, at least through the first 6 months of this year. I don't think it's going to take out these lows right here. So, and members, there's a number of different ways that we trade oil. All of them allow us to make money, as a lot of our members have throughout the year. So that's a little bit about where we are, real quick and dirty. For those of you watching the NFL playoffs, got 2 games today, 2 games tomorrow. Should be really interesting. Otherwise, members, I'll see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. 2023 is going to be a bit tricky. But it's going to offer up ample opportunities. Our members, myself, driving trades, we outperformed the SPX over 40% last year. We were positive in the green, more than double digits. So we had a great year. I think this year is going to be even better, the way the market's going to trade. Have a great weekend, everybody. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao.